Hi everybody, that's Tuesday, March 25, 2025, and let's get started looking for order block model for today's date. So here we have the monthly time frame. Let's go down to weekly. This is how it looks on weekly. We passed that volume imbalance. Let's go over to daily. On daily, what do we have on daily? Looks good. Let's go down to 4-hour time frame. On 4-hour time frame, what stands out, that's this pin candle liquidity. Then hourly time frame, hourly, then 30 minutes, and let's go down to 15 minutes. And as you can see, all of those down close candles, they took that liquidity, and I'm curious if we reach the consequent encroachment of that wick. Perfect, look, just perfect. And the beginning of the order block, and let me see the standard deviations. That's amazing, and yeah, you could trade this one on 15 minutes time frame, targeting this pin candle liquidity from 4-hour time frame. But besides that, I want to show you something more specific on lower time frame. Let me go down. That's 5-minute time frame. 4, 3, 2, 1, and look at that. What do we have here? We have relative equal lows. That's 1-minute time frame. We have relative equal lows being taken. So liquidity was taken. Then these down close candles, that's bullish order block. You make the projection. You take the opening price. That's the bullish order block. And what did I teach you yesterday? It applies to every day. Whenever you have like a target at about, what is the number, 20,501, you want to get out at 20,490. This is what I was teaching you yesterday, 10 points before that. Yes, you could get the exit, the perfect exit, but you would have to wait for another few hours. Look at that. Price came back inside this bullish order block again and only then reached towards the target to standard deviations. So you want to write it down in your study journal. Whenever you have target at even number, in this case 20,500, you want to get out at 10 points before, even though it didn't reach to standard deviations yet. Okay, so let me explain you this setup. Price go down, takes this liquidity, relative equal lows. Besides that, if you take the lowest point here, the highest there, you want to see that price went to equilibrium. Look, price went to equilibrium, took relative equal lows below the equilibrium. Okay, then we have market structure shift right here. The intermediate term high being broken. Why it's intermediate term? Because this fair value gap from here was made new low. Okay, so we have market structure shift to the upside, and then the easiest entry would be 3 ticks above this candle or inside the inversion fair value gap, which would be this one. So it's up to you where would you be getting in, but the easiest would be right over here on this candle. And let me see how it looks in terms of risk reward. And you're getting out at 20,490. This is how it looks in terms of risk reward, and this is how it looks if you entered inside the inversion fair value gap here. Yes, you could be waiting for the 2 standard deviation. but it would take you the whole day, right? Look at that. So hopefully you found this insightful, and until talk to you next time, be well, all the best, and take care. Wow, what you just learned here could change the whole approach to trading. Are you ready to take the next step? Your next big insight is just one click away.